HMRC isn't only getting more aggressive in 2026, they're getting more efficient. And most people don't understand the difference until it's too late. Let me explain what's already happening quietly and why 2026 is where it becomes unavoidable. I'm Salman Anwar, an ex-HMRC tax inspector. I've worked inside HMRC and I've worked at two of the largest UK accountancy firms. Now I use that experience to help entrepreneurs, property owners, and business owners deal with HMRC properly before they lose control or things escalate. If you want a clear, practical understanding of how HMRC investigations actually work, how disclosures should be handled, how to avoid mistakes that cost tens of thousands, sometimes hundreds of thousands, you're in the right place. When people ask what HMRC will do in 2026, they assume something new is coming. The reality is a little bit more subtle and more important. HMRC hasn't been given a raft of new powers, raft of new legislation to go after those who don't pay their taxes. They've been given more money, certain direction, and the remit of closing the tax gap. The tax gap is the theoretical difference between what should be collected and what's actually collected by HMRC, what goes into the treasury coffers. 60+% of that is now attributed to small business non-compliance. HMRC has been given the remit of raising more revenue without increasing headline tax rates. The government committed to not increasing the tax burden, so it now needs to get more tax in, more revenue in from the existing compliance base. So HMRC needs to target more rather than introduce more taxes. That pressure doesn't disappear in 2026. It only intensifies further. 2026 isn't about new powers. It's about using existing powers more effectively. It's about HMRC connecting AI with its Connect database, with overseas exchange of information, with the banking data, with eBay, with Amazon. It's about doing more with less. So the big shift is from inquiries to early intervention and education. Historically, HMRC activity started when an inquiry was open. That's no longer the case. Now, more activity is being conducted informally, whether that's nudge letters, data gathering before an inquiry starts, getting your bank statements without your knowledge, whether it's data from eBay and so on. And HMRC writing out, carrying out certain low-level checks, connecting the data, giving you those nudges, that's where it sits. So nudge letters, one-to-many campaigns, and informal prompts is the way HMRC is going about things. It means fewer random checks and more risk selected cases. So if HMRC is picking on you, it has a reason to do so. It believes you've not paid the right taxes. Now, most people won't realize they're on HMRC's radar until it is too late. Where is HMRC's focus going to be in 2026? Based on the budget measuring, we're already seeing HMRC focus on the small business community. It was given the remit of recruiting and putting together a team of 300 investigators. These are criminal investigators, not civil. So what that means is small business and owner-managed businesses and companies are firmly in the firing line. HMRC is really interested, based on the data we've seen and the letters I see day to day, on director extractions, what you're taking from your company compared to what the company accounts might show. Loan accounts. So if you're a director, owner of a business, if you're loaning money from the company day to day, but you're not recording it properly or you're not returning it properly, how is that stacking up between your tax returns and the company tax returns? What expenses are you claiming? So there's been a huge clampdown on working from home and so on. They've changed what's allowed, but they're also looking at what you're spending your money on. If you're saying you're spending it on social media, if you're saying you're traveling abroad for business purposes, are you really doing it? Those people you see on Instagram and TikTok telling you can take a holiday and add a business trip, be very, very careful. Other things HMRC is really interested in is property and landlords. It's always an easy win for them. It's politically appropriate for them. They have the will behind it. So whether it's undeclared rental income or whether it's underdeclared rental income, HMRC is coming for those people. It wants to know whether what you're spending is repairs, whether it's a revenue deduction, or whether it should really be capital, whether the portfolio that you're disclosing, is that consistent or not. Your lifestyle, if on Instagram you're jet setting around the world, you've got a Bugatti, you've got a Porsche, you've got a BMW, but you're taking out £12,000 a year in salary and not declaring any dividends. Where's your money coming from? HMRC really wants to know where that is. Assets, you own a really fancy house, but your salary doesn't stack up. You're moving lots of cash about. Now, HMRC knows that through its suspicious activity reports from the banks. Where are your funding sources? Who are you taking money from? Are you borrowing from the bank? How are you buying that next property? How are you increasing your development? Overseas income. So under the common reporting standard, HMRC is getting data from across 100 plus jurisdictions. The most recent one that I've seen is from Pakistan and India, amongst other jurisdictions. If you've got a bank account earning interest, if you've got land that's generating income from that land, you've got rental income coming in. If you've not disclosed that historically, you may need to take some advice. The simplest position is if you're UK tax resident, you need to pay tax on your worldwide income in the UK. This isn't about one big mistake. It's about patterns that don't make sense to HMRC. And if you're worried about anything you're hearing right now, there's a link in the description. You can find out how to get in touch with a specialist advisor with over 13 years of experience. Now, the part that most people misunderstand, HMRC's objective. It isn't to investigate everybody. It can't do that. It's gone from an organization that had 100 plus offices to 13 regional centers, from close to 100,000 workforce over 10 years ago to currently sitting at around about 40 to 50,000 people. It just simply does not have the manpower to go after everybody it suspects. So what is it going to do? It's going to raise revenue more efficiently. What that means is it wants to send out those nudge letters. It wants to carry out the educational campaigns. It wants to do things on the one-to-many basis, move compliance upstream, and make you do its legwork for it. So early correction is cheaper than a full investigation. If you're going to wait for HMRC to reach out to you when you know there's something wrong, it's going to cost you more. Prompted disclosures lift the penalty ranges by at least 10%, sometimes way more. For example, offshore disclosures for 2016 or earlier years could get you a penalty of 100 or 150% based on whether it's unprompted or prompted. Behavior becomes a battleground. Did you do this knowingly? Were you careless? Did you have a reasonable excuse? Those things need to be controlled and managed from an early stage. In most cases, HMRC makes more money from how people respond than from the original error. Penalties and interest stack up in some cases more than the taxes. So what does this mean for you if you're a business owner or investor? Expect HMRC to contact you at some stage over the next few years. My mantra at the moment is it's a matter of when, not if HMRC will contact you. Expect to get an inquiry, expect to get deeper review of your records at some stage. Initially, you might be given a nudge or an educational letter, but at some point, HMRC will follow that up. Remember, it has the power of AI on its side now. It's rolling out co-pilot licenses to almost all of its compliance staff. So coupled with the data collection, connect an AI, as well as AI at the fingertips of the investigators, it means there may well now be very much less patience for sloppy records, faster escalation when responses are poor, and very little leeway if you've got things wrong. Most problems I see didn't start as fraud. They didn't start as complex matters. They started as casual responses to early HMRC contact without the right advice, without the right specialist being involved. So the real risk in 2026 isn't HMRC. It's you being complacent. Silence from HMRC doesn't mean safety. Just because they haven't come after you doesn't mean they won't do so. Leaving small issues to fester, not fixing them, isn't going to cut it anymore. Assuming HMRC isn't going to join the dots, it's a fatal mistake. By the time HMRC opens a formal inquiry, most of the strategic decisions have already been taken. Nonetheless, there's still stuff you can do to make sure you come out the other end in the best way possible. 2026 isn't about panic. It's about preparation. Understanding how HMRC operates, not how it used to, is what keeps you in control. Getting the right advice, at the right time. Ensuring you know your rights from your wrongs and your rights is the most important thing. If something here feels uncomfortably familiar, deal with it early while you still have the choices. If you'd like to get in touch, there's a link in the description. You can book a free initial consultation. I'm Salman Anwar. Thank you for watching.